Imagine walking into a casino where the building is literally on fire, yet the people at the roulette table are doubling their bets because the house is handing out free chips. That is exactly what the US stock market feels like right now as we kick off 2026. We just witnessed something historic. In the final stretch of 2025, a staggering $20 billion poured into the Vanguard S&P 500 ETF alone. That brings the total haul for the year to over $125 billion. Retail investors and institutions are frantically chasing this rally. But if you look out the window, the real economy tells a terrifyingly different story. While portfolios were hitting all-time highs, 1.2 million Americans received pink slips last year. That is the most aggressive wave of layoffs we've seen since the 2020 lockdowns. Consequently, the unemployment rate has ticked up to 4.6%. Now, for the data nerds out there, this triggered the Sahm Rule. Think of the Sahm Rule as the check engine light for the U.S. economy. Historically, whenever unemployment rises this quickly off a cyclic low, a recession isn't just possible, it's usually already begun. If you look at the history books, the worst market crashes, like the dot-com bust or the Great Financial Crisis, didn't happen when everything looked bad. They started exactly when unemployment began its ascent. So, are we looking at dumb money buying the top of a sinking ship? Well, not exactly. It's more calculated than it looks. The financial system is currently caught in a strange feedback loop. When the economy starts to crack, when jobs vanish and GDP stalls, the Federal Reserve panics. They rush in to cut interest rates to stop the bleeding. Here's the analogy. When rates are high, cash is king. When the Fed cuts rates, cash becomes trash. Investors are forced out of safe savings accounts and pushed into riskier assets like stocks, real estate, and crypto just to beat inflation. This is why the market is ripping higher while the average worker is struggling. The Fed is essentially pumping oxygen into a room that's losing air pressure.
We saw this exact movie play out in October 2007. The S&P 500 was screaming to new highs because the Fed was cutting rates, even as the housing market was crumbling underneath. Investors took on massive margin debt right at the cliff's edge, moments before the 2008 collapse. So is 2026 just a repeat of 2008? The charts look similar, particularly with margin debt exploding again. But there is a massive twist this time. Let's talk valuations. The S&P 500 price-to-earnings ratio is sitting at a lofty 22.5. To put it simply, stocks are expensive. Historically, buying at these levels usually results in dead money or zero returns over the next 10 years. However, here is the secret that Wall Street doesn't like to advertise. Valuation is a terrible timing tool. It tells you where the market will be in a decade, not where it will be next week. You can buy an overvalued market and still make a fortune in the short term if the momentum is there. This is what we call a melt-up. And that brings us to the real engine driving this car, artificial intelligence. While the broader economy is shedding jobs, the tech sector is posting record numbers. In 2025, while other industries struggled, big tech earnings surged by 21%. This isn't 2008, where the banks were insolvent. This looks a lot more like 1999. Back then, the internet was the new frontier. The Fed was easing policy, and investors didn't care about valuations. They cared about growth. We're seeing that same irrational exuberance today with AI. Remember, the dot-com bubble didn't pop because prices were high. It popped because the Fed eventually took away the punch bowl and hiked rates. Today, the Fed is still cutting. They're still pouring liquor into the punch bowl.
This suggests that despite the red flags in the job market, this bull run might have one final explosive leg higher. We're likely in the late stages of a mania, similar to the late 90s. The risks are astronomical, but so is the potential reward if you know when to exit. This is why buy and hold might be dangerous for the next decade, but active trading is the opportunity of a lifetime right now. You don't need to be a hedge fund manager to navigate this. You just need a system that separates the signal from the noise.